The majority of the stocks in the S&P right now are down in the red. However, when we look at just over the last week, one of the industries that's been hit the most is the semiconductor space. And today we're looking at 6 undervalued semiconductors with massive upside. Now, each one of these will be trading either at their 52-week lows or near enough, and we believe they are good considerations for the portfolio. Let's jump straight in then. Number 1, Lam Research Corporation. As we can see right there at its 52-week low, we get a double buy rating from both Seeking Alpha and Wall Street. Quant though do give it a hold, and it pays a dividend, currently 1.3%, forward PE just below 20, S&P right now around 24.5, and over the last year, not the best performance, down negative 2.6%. Over the last 10 years, if you have been a shareholder of Lam Research, you would have outperformed significantly the S&P 500, up 748%. In fact, you would be up a little bit more if you were reinvesting those dividends. In terms of the expectations moving forwards, we can see double digit every single quarter anticipated by management to the EPS, and we also notice 100% track record. 4 out of the last 4 quarters have been a beat. Love to see that historical forecasting accuracy. And over the next full year, management expect 4.23 on the EPS, there in turn lowering the forward P to 16.7. In terms of dividend safety, well, 66 looks to be safe. Undervaluation on the yield, undervaluation on this model that we will get to, and a very strong 15% dividend increase in August this year. We do love those double digits, and it was reaffirmed just a couple of weeks ago. Dividend is safe, ultimately meaning a dividend cut for LRCX is unlikely. Now, in terms of some key metrics from the 07-09 Great Recession crash, no dividend paid, so no comparative data. Below average growth, negative 55, S&P itself, negative 12, and they also marginally trailed the S&P, negative 64, S&P itself, negative 55. As we can see, very attractive increases to the dividend. In fact, 46% year on year over the last 10 years, whilst paying a dividend consecutively with increases for the last 10. Now we're going to take a look at this valuation model, but remember, we will conclude when we run it through our own valuation process, and we're not looking at any of these one models in isolation. Now the blue tunnel here represents the expected fair price. Pretty much the majority of the last year, it's been above that. That is severe overvaluation. Right now, it's sitting just outside. That is a cause for severe undervaluation. Definitely something we like to see. As always on this channel, we want to consider high quality companies that look undervalued. We then move on to dividend yield theory that states a company is undervalued when the current yield sits above the 5-year average. Another undervaluation signal. However, based on the forward PE, 19.2 currently, not far off the 5-year 19.6, so solely on this model, that is a reasonable signal. And then when we do take a look at some of the other financial metrics, first one, the free cash flow payout. Remember, on this channel and as we go along, we'll focus on free cash flow. Earnings data is susceptible to manipulation by management through accounting, and below 50% for semiconductors. Reason we have targets to have confidence management can continue to increase the dividend at a very attractive rate. And what we notice every single year, well below that, no surprises then, we got that double digit increase over the last 10 and 27% over the next 12 months. We would be surprised if these increases don't continue. Free cash flow per share consistent over the long term is what we want, near enough what we get, and we can in fact see over the next 12 months a small increase is anticipated to 337. Lots of great news from these metrics so far. Then we get to the sales growth. Bear in mind, semiconductor space is cyclical. Some companies will see in their numbers a lot more prominent than others. 3 to 7% is what we want at a bare minimum, 3 to 4 just to keep up in line with inflation. Now when you zoom out, it does look good, but unfortunately 2 of the last 10 years, and including 2024, their top line has dropped double digits. And when we do ultimately zoom out, we do notice they've tripled their top line. 2015, 5.3 billion, 2024, just under 15. We also love the fact when companies not only increase their dividend at a double-digit rate, but also return excess cash through those share buybacks. 1.77 in 2015, 1.31 over the last 12 months. So this is very good to see, a very nice added bonus for dividend investors. Then we move on to the ROIC, 10% or more. Give us faith, management are able to effectively allocate their capital. 12% for semiconductor space, looking very strong and increasing. 34% on a trailing 12-month. Investors, as well as those considering, will love to see that. Incredibly attractive. Then we get to the margins. Not only above 16% minimum is what we want, but we also want efficiencies, something LRCX has given us. 17% in 2015, 29% in 2024. We also want to see free cash flow margin above 5%. Again, looking very attractive here. 31% on a trailing 12-month and consistently above the minimums. Finally, we get to the net debt to EBITDA, and we know we've been singing their praises today, but that does have to continue on this metric. Below 1.5 is what we want to see. Net debt to EBITDA, referencing earnings before interest, tax, depreciation, amortization, and the numbers that you see below are the number of years it would take LRCX to pay off all of their debt, net of cash on hand. And remember, this metric here correlates dividend safety and balance sheet strength, ultimately telling us in 2024 and on the trailing 12 month and over the next 12 months, it won't even take this semiconductor company one day to pay off all of their debt, net of cash on hand. Very, very strong balance sheet indeed. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically we do deep dives on these companies and we run through every single one of these models, the inputs and outputs. Today, getting straight to it, our intrinsic value at $98, pretty much in line with Wall Street. They see 40% over the next 12 months. That is massive, definitely one to consider. And likewise, we believe the same. We have an MOS that we always use for each company. We execute on 10% if they meet our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Well, if you believe that for Lam Research, a buy up to $88, and then we keep going until it's near the current trading price. And what we can see in today's episode, a very large MOS, not at the 30% point just yet, not far off, but somewhere between 25 to 30, with, as we said, Wall Street very bullish, 40% over the next year. As always, give us your thoughts in the comments below if you're looking to buy any of these, maybe hold, or in fact if you have a reason to sell. We also want to let you know we have released our latest free weekly article. We deliver one every single Monday morning to your inbox where we discuss severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and start reading straight away. You'll also be able to gain access to 40 undervalued dividend stocks for the month of November. Lots of information for each, as well as the upside that Wall Street see over the next 12 months. And on top of that, you will be able to grab a spreadsheet of 22 undervalued dividend stocks that Wall Street themselves believe have the most upside out of the whole S&P 500 right now. So as we said, click below, sign up, and you can start reading straight away. We then move on to KLA Corporation with another double buy and that hold from Quant, trading towards its 52-week lows with a yield of 1.1%, and we can in fact see a forward PE just above 20. Over the last 12 months, up 10%. Over the last 10 years, another one similar to Lam Research, significantly outperforming the S&P, up 783%. We also notice out of the next 4 quarters, every single one, they're anticipating growth to the earnings per share moving forwards, and they've also got that 100% track record to their earnings over the last 4 quarters. Ultimately, EPS is expected to grow, and the forward PE is expected to come down 18.8. Then we move on to the dividend safety. Looks to be safe. We'll run through these 2 metrics shortly as well. And love this again. 15% we saw for Lam Research, 17% for KLA in September this year. Then when we do take a look at those key metrics, they maintained the dividend during the previous recession, didn't increase it, also didn't cut it. They had below average growth, negative 44%, and they significantly trailed the S&P, negative 70%. In terms of dividend growth though, it is typical for them, like Lam Research, to continue to increase those dividends at a very attractive double-digit rate, and they've also been increasing them for the last 14 years consecutively. Now, what about the valuation? When we do zoom into over the last 12 months, we can see, similar to Lam Research, been looking overvalued up until now. Right now, bang in the middle of the intrinsic value, therefore this model is showing reasonable valuation. In terms of dividend yield theory as well as the forward PE, you could argue more reasonable signals as they both aren't far off the 5-year rolling average. And when we do take a look at their financial metrics, more specifically starting off at the free cash flow payout, what is great to see is that it is decreasing over the longer term, 23% over the next 12 months. So again, similar for this one, we do anticipate September 2025 double-digit increases to definitely continue. Also love the free cash flow that it has been increasing consistently over the longer term, and over the next 12 months it is expected to rise very sharply. In terms of sales growth with Lam Research, we saw 2 out of the last 10 years being negative, same on KLA Corporation, and in fact 2024 again mirroring that drop that we did see from LRCX, negative 7% however for KLAC. In terms of their top line, well, been growing at a very attractive rate, more than 3 times over the last 10 years, and they've also done share buybacks, maybe not as aggressively as we saw for Lam Research, but nonetheless looking very good, a nice bonus. And then ROIC, no complaints whatsoever, well above the minimum, 35 again. These are some very, very attractive numbers and not something we see across all industries that we do cover on the channel. Operating margin, again, absolutely phenomenal, well above the minimum, operating efficiency as well, and another free cash flow machine. We do really like both of these companies, which are towards, or if not, at their 52-week lows. And again, no complaints whatsoever. Net debt to EBITDA showing a very strong balance sheet, 0.47 on the trailing 12 month, expected to go lower over the next 12. Again, lots of positive signs here. And importantly, when we do run it through the valuation, our intrinsic value, $840, is higher than Wall Street, $810 over the next year. They believe there's 32% upside. Again, nice to consider for the overall portfolio. And when we do run it through the margin of safety, at 10%, a buy at 756, at 20% around 671, and in today's episode, not quite at the 30% level just yet at 588. It is sitting pretty much 25 to 30%, you could argue, with, as we said, Wall Street 32% upside is what they estimate over the next year. Give us your thoughts below for KLAC, whether it's a buy, hold, or sell. We then move on to Micron Technology with a strong buy from Wall Street, a buy from Seeking Alpha, and a buy from Quant, trading towards its 52-week lows. Now one of the lower yielding today at 0.47%, a forward P, one of the lowest as well at 10.96%, and actually very good performance over the last year, although marginally underperforming the S&P, up 24%, and also over the longer term, outperformed up 170, although it has pulled back quite some way away from its 52-week high at $158. In terms of growth, well, they do expect that moving forwards over the next few quarters, and another 100% track record, and just look at that growth projected August 2026, thereby lowering the forward P down to 7.59. When we get to dividend safety, we do get our first borderline safe score today, and we'll cover these models, but important to understand for this company, whilst they do pay a lower yield, they also haven't increased that dividend since 2022. Now, it was reaffirmed last week, borderline safe score, and what this ultimately means is there's a moderate risk of a dividend cut over a full economic cycle. Also noted in the last recession, they did have negative 18% sales, which was well below, as we said, the negative 12 of the overall S&P. In terms of the valuation, we get an overvaluation signal today, and when we zoom in over the last 12 months, similar to the previous two that have been overvalued for the large part of the last year, Micron Technology hasn't just yet, based on this model, reached the expected fair value tunnel, something to consider, but as always, we put it through our own model. And when we look at dividend yield theory, not far off, but you could also argue slight overvaluation. However, when we look at the forward PE, right now it does trade below the 5-year of 13.5, and as we can see, that is essentially an undervaluation signal. In terms of the free cash flow payout for a company that hasn't increased its dividend since 2020, we do in fact notice on 2024, that is what we call a red flag indicator, triple digits indicating management paid out more in dividends than they generated in free cash flow. Positive to take from here though is over the next 12 months, this is anticipated to come down to 16%. In terms of free cash flow, we do get a lot more of the cyclicality shown through these numbers. They're not consistent, however a large growth increase is expected over the next 12 months. And when we get to sales growth, whilst the previous two semiconductors had 2 of the last 10 years as negative, we do in fact note for this company 5 of the last 10. However, unlike KLAC and Lam Research, this company, Micron Technology, had a large increase to their top line at 62% in 2024, and we can see though inconsistency on a numerical basis. In terms of shares outstanding, very minimal movement over the long term, 1.17 in 2015, 1.12 from the latest quarter. ROIC, again, inconsistent as well, so you could be thinking maybe this isn't a company you want to consider in comparison to the other two which did look stronger. Nonetheless though, just putting these facts here, 2% in 2024. And when we do look at the margins, both free cash flow and operating, we do get that continued sense of inconsistency right throughout. And more importantly, the net debt to EBITDA, when we look in fact on a trailing 12-month, 0.65, expected to go lower, it does have that commonality with the other two that the balance sheet does look to be strong. Now, first thing to note, the upside may be the highest so far at 55%. Wall Street have their price target at $150. And when we run it through our MOS today, you will find we have quite a significant one, pretty much right now trading with a 30% margin of safety, upside of 55% from Wall Street. But out of the three so far, purely based down to the metrics, and if you do include the margin of safety and the upside, this one does seem to be weaker. Nonetheless, nice upside and margin of safety, and give us your thoughts below. We then move on to Microchip Technology, which is trading at its 52-week low. We have a bit of a traffic-like system, Wall Street with a buy, seeking alpha with a hold, quant with a sell. We notice the yield more attractive, 2.8%, forward PE more unattractive at just under 40, and over the last year, down 25% over the last 10 years. Interestingly, whilst this year hasn't been great, they've still over the long term outperformed the S&P, but as we can see, quite a pullback, in fact around 40% from their 52-week high. In terms of moving forwards, only one of the next 4 quarters they're expecting growth, but nice to see out of the previous 4, 100% track record. Moving forwards, EPS is expected to grow and bring down that forward P significantly to 25.18. In terms of dividend safety, another borderline safe score, a double severe undervaluation, and Microchip Technology is coming in with the highest dividend growth so far. In terms of borderline safe, we have already mentioned what this essentially relates to, and in terms of the key metrics, well, they increased the dividend in the last recession below average growth, but they actually outperformed the S&P with their negative 40% return. Again, following on the theme with the semiconductor space, nice double-digit increase to their dividend over the long term, and they've been increasing the dividend for the last 21 years, meaning they're 4 years away from gaining dividend aristocrat status. In terms of the valuation model over the last month, in fact pretty much over the last year, MCHP has been showing a lot of signs of severe undervaluation, and this is also reflected on dividend yield theory. In fact, the yield offered today is the highest over the last 5 years. However, based purely on the forward PE, it does look to be overvalued. Then when we take a look at that free cash flow payout, a little bit of a red flag indicator because we want to see below 50% over the next 12 months at 89%. Definitely something we would factor into our margin of safety later, but perhaps that is one element of why the dividend safety does sit at borderline, and the free cash flow, not something we really want to see. Great up to 2024, but it does look like another year where it is anticipated to come down quite sharply. In terms of sales growth, well, out of the last 3 companies we have looked at, it is mirroring them, with 2 of the last 10 being negative, including 2024. And when we zoom out, we do notice it has pretty much nearly quadrupled their top line, but based on the trailing 12-month, their sales is anticipated to take a large hit in 2025. In terms of shares outstanding, the first one we've come across today that have actually diluted your position as a shareholder, so again, more things just to factor in. ROIC, whilst not consistent over the last few years, has looked fairly good, around 14 to 24%. And then when we take a look at the margins, we do get a little bit of operating efficiency. Main thing is it is above the minimums over the longer term, and the free cash flow, absolutely no complaints. One real consistency that we do get with Microchip are those free cash flow margins. Net debt to EBITDA, definitely something of a concern, another red flag indicator. 4.59 over the next 12 months, and as we said, this and that essential free cash flow payout are the main reasons why we do get that borderline safe score. We ideally want to see them start to delever the balance sheet and start to pay off a lot of that debt. So MCHP, our intrinsic value, $96, above Wall Street's 86, where they see upside of 34% over the next year. When we look at it from an MOS perspective, well, in today's episode, you are looking at least 30% up to $67. In fact, 35 would be around 62, 63. Not far off that, but to conclude, we would say 30% margin of safety with 34% upside. Again, give us your thoughts below. We then have Applied Materials with a double buy and a hold from Quant, trading towards the 52-week low, a yield of just under 1% and a forward PE just below 18. Over the last year, well, up 10%. Over the last 10 years, massively outperformed the S&P, up 600%. And when we look at it, very nice to see green right across the board, growth anticipated every single quarter moving forwards, and also 100% track record, meaning that their earnings per share as well, with growth, that forward PE will lower to 15.85. We also have our very first very safe dividend score today, and we have two reasonable valuations with another very strong dividend increase at 25% at March this year. In terms of very safe, well, reaffirmed back end of August, and this tells us a dividend cut for Applied Materials is highly unlikely. Now, last recession, they maintained the dividend. They had below average growth, but they had a near S&P return, negative 57%. And again, similar to the trend of this space, double-digit increases has started to become a common thing, especially when we do zoom out and look over the last 10 to 20 years. We also notice they've been increasing those dividends for the last 7 years consecutively, whilst paying a dividend without a reduction for the last 19. Then we get to their valuation over the last month. What we notice is that right now, for the first time in quite some time, it is looking reasonably valued well within that intrinsic value tunnel. And when we get to dividend yield theory and forward PE, both of them giving us the very same signal that they are near the 5-year averages. In terms of the free cash flow payout, what we do notice, it is very, very low, so no surprises why this company has been increasing those at a rapid rate. 20% expected over the next 12 months. Free cash flow per share, whilst very inconsistent, some years pretty much flat as we can see here, nonetheless increased at a very rapid rate, more than 10 times, but it is expected to take a hit over the next 12 months. In terms of sales growth, well, only 1 year that's been negative, and that isn't the more recent year where we see a marginally below inflation increase. And when we zoom out with this company, nearly tripled their top line from 2015 to 2024. What they've done very, very aggressively, love to see this, is do a lot of share buybacks over the period, something we can really get behind as investors. And no real complaints about the ROIC, phenomenal, well above the minimums, and we're talking 31% on a trailing 12-month basis. Operating margin, we get some operating efficiencies well above the minimum, and free cash flow margin, something we've seen for pretty much the majority of companies today, maybe bar Micron Technology. They are true free cash flow machines. Net debt to EBITDA, phenomenal, couldn't really be that much better. Over the last year, trailing 12 months, next 12 months, 0, meaning it wouldn't take Applied Materials 1 day to pay off all of their debt, net of cash on hand. Now, our intrinsic value, $237 at a 10% MOS, a buy at 213, at 20% around 189, at 30% not quite there yet, so it sits between 25 to 30% in today's episode, with Wall Street again very bullish on the semiconductor space as a whole, but giving AMAT 32% upside and 25% at a bare minimum MOS up to around $178. We then move on to MPWR Monolithic Power Systems with a buy from Wall Street and a double hold from Seeking Alpha from Quant. This one again trading towards its 52-week lows with the yield of 0.85%, probably the highest forward P we've seen today at 41.84. Marginal increase over the last 12 months. Over the last 10 years, though, absolutely phenomenal. Actually, the best we've covered today, up 1,112%, massively outperforming the S&P. And over the next 4 quarters, they are expecting double-digit growth to the EPS quarter on quarter, and we can see 100% track record. And note that over the next full year, EPS growth is expected to continue, and therefore lowering the forward P to 35.03. Now we get another borderline safe score of 60 and a double undervaluation, and now we are getting to the point where we're not surprised anymore. 25% increase to the dividend in February this year. In terms of key metrics, well, no dividend was paid 0709, above average recession sales, and also marginally outperformed the S&P. They've also been increasing those dividends at 27% year on year over the last 5, whilst increasing those dividends over the last 6 years on a consecutive basis. In terms of the valuation model over the last 12 months, again, we are starting to see this theme. Semiconductors over the more recent period have started to become very undervalued, especially the ones that we have covered today for the first time over the last 12. Then we get to dividend yield theory, in fact, as well as the forward PE, where we have two strong signs of undervaluation, which is good if this is a company you are looking to consider. And then on the free cash flow payout, a little bit inconsistent, and below 50% is what we want. We don't get it every year, but 33 in 2023, 34 in a trailing 12 month, and 39 over the next 12. They've also increased their free cash flow over the longer term, but as you can see, very, very inconsistently, and a small increase is anticipated over the next 12 months. Now, maybe the first one we've covered today that actually has no decrease to their top line over the last 10 years. On the trailing 12 month, looking very good at 12%. And when we do zoom out, we can see they reported 280 million top line in 2014, 1.82 billion in 2023. Now, for the second time today, this company would have diluted your position as a shareholder, but you really wouldn't care, as we saw share price over the same period increase more than 1,000%. ROIC, no complaints. In fact, they have been increasing over the long term, and 23% is still very solid in 2023, as well as 21% on a trailing 12-month basis. And then we get to the operating margin. Again, no complaints. Real efficiency shown, 10% in 2014, 26% in 2023, and the same to be said on the free cash flow, although it is a little bit inconsistent. Nice to see 33, 34 on the trailing 12-month. Finally, net debt to EBITDA might be the first one we've come across today, actually. 0 right across the board, and over the next 12 months, not even one day to pay off all of their debt net of cash on hand. Phenomenal balance sheet. Now, our intrinsic value, you will have spotted here at $700 today, is significantly lower than Wall Street. They have $909. They see upside of 56%, making it the highest we have seen today. Nonetheless, when we do look at our MOS at 10%, a buy at 629, at 20%, not quite there yet at 559. So in today's episode, up to $594, we believe MPWR, 15% MOS, 56% upside. Now remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for MPWR or any others that you do desire. Give us your thoughts about these companies below, and if you did enjoy the content, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to click below, sign up to the free weekly newsletter, and also come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.